Retirement costs a ton of money, and so does making mistakes. You put the two together, and that is a bad combo. My name is Reese, and today I'm going to highlight 10 really common retirement mistakes so that you can avoid them. Number 1, no retirement plan. This one is massive. Going into retirement without having a strategy for how much you can safely spend, how much to pull from which accounts and when to do it, how to keep your taxes low, how much you should have in cash reserves, how much you should have in investments, etc., is a profoundly sketchy move. And I can say that with a lot of confidence because we do these kind of plans for people all the time. It's actually the main thing that we do. Now, I'm a chartered investment manager and a fellow of the Canadian Securities Institute. So I absolutely understand the importance of having a solid portfolio. It does matter. And so I make sure that we partner with top shelf portfolio managers to make sure that that is absolutely taken care of. But I can also tell you that in our regular client meetings, the portfolio is like a 3 to 5 minute conversation most of the time. As long as it's doing what we want it to, what we expect out of it, then we're good. What most people really care about, what they really want to know about is, what does my future look like? What are the implications of different decisions that I'm thinking of making? The portfolio is just a means to that end. What people really want to know is, will I have enough? Or will I run out? Or what happens if I retire a bit earlier or a bit later? Or what if I downsize or semi-retire? What if we give the kids some money for a down payment? How do we stop paying so much frickin' taxes? You get the drift. The thing is, there are solid answers to all of those questions. Now, obviously, the answers are going to look different for you in your particular situation, but there are answers. And going into retirement without those answers is not just financially dicey, but it's also mentally fatiguing. If you do not have a solid retirement plan, get one. It's a game changer. It's like turning the light bulb on. And I know I've said in the past that you should ask your advisor to make you one. But honestly, if you have to ask them, aren't you dealing with a bigger problem than just that? Anyway, we do these kind of plans for people all over Canada all the time. So if you need one, feel free to pop over to our website for details. Number 2, paying ridiculous fees. If you want competent help, we all understand that that is going to come with the price. But I think it's also becoming more and more common knowledge that in Canada, people pay an obscene amount on average for financial services fees, and they get almost nothing in return. And unfortunately, I'm not exaggerating when I say that. We're actually bringing on this new client from Vancouver Island right now, and she is absolutely hilarious. And she was describing her situation with her bank recently about how when she goes in and she talks to her advisor, she feels like she knows more than he does, and she doesn't feel like she actually knows a lot. And she gets the sense that when she's speaking with him, that she may actually be interrupting him from his video games. Now, it's funny because of the way that she said that, but it's also not funny because they are paying almost 2% a year of the total value of their portfolio in fees. That is a lot of money. That's a lot of money for a good advisor, never mind the unfortunate reality that many people are dealing with. The fact is, there are way better options available, and I know that because we are one of them. Shaving off even a quarter of those fees could lead to years of additional income in retirement, and that is a hard fact. Number 3, paying more tax than you need to. Now, this one builds off of the first mistake, which is not having a retirement plan. But because it's such a big issue, I felt like it deserves its own space, and it does. If you do not carefully think through which accounts to pull from and when throughout retirement, then you are likely going to give CRA more money than you need to. And you could very likely be giving them way more than you need to. And because this is such a big issue, I really do want to illustrate it, but I'm going to do it quickly and simply for you so that you can see exactly what I mean. Johnny and Nahani have a pretty decent setup. They have a few years until retirement, and they have RRSPs, TFSAs, and a chunk of non-registered investments as well. Good stuff. And in this particular example, if they were to hold off on taking their RRSPs and chose to draw down their low tax investments first, which is their TFSAs and non-registered account, then this would put them at 94% on track of reaching their retirement income goals. And it's leading to an estate of $3.73 million when they pass away. But if we switch it up and choose to draw down all of their high tax investments first, which is their RRSPs, and leave their non-registered and TFSAs for later, it drops them down to 92% on track and drops the final estate value down to $3.63 million. So that's a no-go. And if we look at drawing proportionately from all of their accounts all throughout retirement, then it bumps them back to 94% on track. Not bad. And it also leads to an additional $111,000 in their estate. And if we choose to limit their taxable withdrawals, which is to say that we are going to look for a sweet spot for how much to pull from their RRSPs each year based on their tax rates, and we can see that it's bumped them up to 95% on track and beefed up their estate by another $46,000 to a total of $3.78 million. Anyway, we can and do work with these numbers until we find just the right way to do it in every different situation. Point is, how you draw down your accounts matters, and going in willy-nilly can be a really expensive mistake. Number 4, not adjusting spending habits. The early years of your retirement, the go-go phase, can be a really great time. Obviously, you're still young and hip, you're traveling and just ripping it up in general. But the switch from a steady stream of employment income to a stream of income that's coming from your own investments and pensions, etc., can be a very real switch. And for most people, it's not as much income as they were used to making before. And so you have to adjust accordingly. And even if you weren't using a budget before you retired, you need to start using one now, because running out of money in retirement is no bueno. So know your limit and play within it. Number 5, forgetting to plan for annual taxes. When you're working, you generally have one main source of income, and your taxes are generally withheld right off of your checks. And so you really don't have much to think about in that regard. But when you retire, you usually end up with money coming in from all sorts of sources like CPP, OAS, maybe a pension, a RIF, etc. And so things get a bit more complicated, and so does the tax situation, because not all of these sources of income are taxed the same or in the same way. For instance, CPP and OAS are both taxable income, but the government won't automatically hold back taxes for you. You have to choose that, and you have to choose how much. Another example is RIF income. When you have a RIF, there is a minimum amount that you have to take out each year based on your age. It's a percentage, and it's taxable. But there are no taxes withheld on the minimum amount, unless you ask to have it withheld. I'll post a link to a really good article on this down in the description. The moral of the story is know your different income sources, how they're taxed, and then how much you should have withheld at source so that you don't end up with a nasty surprise come tax time. An income tax calculator can really help with this, and so I've posted a link to one below. And just so you know, this normally takes people a few years to get it just right, so don't beat yourself up if you're a little off in the beginning. Number 6, giving too much to adult children. This is a tough one. These are your kids, and you love them, and you want to help them, and given the state of things out there right now, they may legitimately need some help getting their first home or whatever, and all of that is totally fair. But just make sure that you know your numbers and the implications of any amount that you're thinking of giving before you actually go ahead and pull the trigger. If we hop back into Johnny and Nahani's situation, we can see that if they gifted $50,000 to their daughter next year, that it drops them down to 91% on track of their retirement income goal. And it also shaves $210,000 off of their estate, since that money is no longer available to compound and grow on itself. Now, they may want to see their money help their daughter now more than after they're gone, so this may be totally worth it for them, but they still need to do the math and make sure that they know their numbers. Now, as it stands, giving this amount, they may be able to pull this off and just mitigate it by maybe working for an extra year before they retire, or maybe reducing their retirement income budget by just a bit. They have some options. But if they were to give her $100K, that would drop them down to 86% on track, and that may be further than they're prepared to go. Bottom line is, giving is a wonderful thing to do. I love doing it, but just go in with your eyes wide open. Number 7, retiring too late. Again, this really just loops back to the first mistake that we were talking about. If you don't have a well-built retirement game plan in place, it makes it really difficult to understand exactly where you stand. And so you may end up working far longer than you actually need to in order to save up what you think you need when you may not actually need that much. That may sound a little bit ridiculous to some of you, but it's really not that uncommon at all. We regularly do retirement plans for people who have worked hard and saved hard for a long time, and they have quite a bit of resources. And it is a great joy to be able to look them in the face and tell them that they can go in tomorrow and hand in their notice if they want to. The early years of retirement can be so rich and so enjoyable because you're still young-ish and healthy. And if you're working in a job that is stressful, adding extra years of all of that stress to your life can really rob and steal a lot of that away from you. And that is an absolute shame. But again, it really just comes down to knowing your numbers so that you can confidently make the decision. Number 8, not enjoying the early years of retirement. What I'm getting at here is about how much you spend. A lot of people make a retirement plan to spend the exact same amount of money all the way through their retirement, but that's usually not how it works for most people, and we see that play out all the time. Most people tend to spend a lot less as they age. Now, obviously, there can be medical and care expenses that can really add up and cost quite a bit in those later years of retirement. However, at the same time, you also see a lot of the other expenditures just dropping right off. So feel free to plan however you want to, but we recommend that people plan to enjoy the early years of their retirement. And yes, that's going to cost more in those earlier years, but that's okay because we build it into the plan. Rather than a static income all the way through, we encourage people to plan to spend more during the go-go stage, a bit less in the slow-go stage, and a bit less than that in the no-go phase. Again, tweak this for however makes sense for you, but almost no one spends the exact same amount all the way through retirement. Number 9, not planning for health expenses. Now, I realize that I just said that people tend to spend the least amount during their no-go phase, and I meant that. It's true. But obviously, if you want to live in a top-end care facility in your final days, then you need to plan accordingly because obviously that is going to be more expensive. But usually in our planning, those who have those kind of expectations usually have other assets like a home to fall back on. And we almost never plan on liquidating the home unless it's for reasons exactly like these. But health expenses can be an issue at any time, not just your final days. So building them into your retirement budget is a wise idea. There are health insurance packages that you can buy, but unless you have the option of continuing one from your employer after you retire, in my opinion, these insurance packages tend to be more pricey than they're worth. Definitely feel free to look at your options, but I tend to favor simply building a reasonable health expense into your ongoing budget. Now, obviously, any list of mistakes can go on forever, but you're probably starting to get sick of my face at this point, so I'm going to wrap it up with just one more. Number 10, not accounting for the realities of relentless inflation. A very common mistake is to make your investment portfolio too conservative when you retire, and this really is a mistake. Now, obviously, if you have a very low risk tolerance to begin with, then you just do whatever you got to do to get through. But if you don't, do not neuter your ability for your portfolio to continue to grow over the long run just because you're retiring. And yes, for most people, it's still a long run. If you retire at 65 and live until 90, that's another 25 years. Now, I could get quite deep with this, and I really probably should, but that's going to be its own video, I think. The key point is that if you move your investments into assets that have a difficult time keeping up with inflation, especially after you factor in taxes, then you will burn through your resources much faster than someone who owns assets that have the ability to outpace inflation. I'm definitely not saying that you need to go full tilt and aggressive. No, always diversify and work within your ability to put up with market volatility, for sure. And I'm also not saying that you should do this with all of your money. I just did a video a few weeks back on the importance of having a big, fat, liquid, and boring war chest throughout retirement. But what I am saying is that history has shown us repeatedly that inflation permanently steals your purchasing power. Full stop. And it is relentless. It does not stop. While market volatility, on the other hand, is always temporary. Owning some of the world's biggest and best businesses, yes, can be a bumpy ride. But over time, it leads to growth on top of growth on top of growth. Never mind the constant flow of dividends that just keeps coming and coming when you own a portfolio like that. And that is not something to give up on just because you've retired. Remember, you're still young and hip. Well, at least for the go-go phase.